HAUS Talk Tuesdays, where homeownership meets luxury, legacy, and lifestyle. I'm your host, Daphne Davis, your trusted real estate expert, entrepreneur, and wealth builder. This isn't just a podcast, it's a movement. Whether you're buying your first home, investing in your future, or elevating your lifestyle, we're here to give you the insights, inspiration, and strategies to build a life of wealth and sophistication. So grab your favorite drink, settle into your dream mindset, and let's talk house. Because home isn't where you live, it's where you build your legacy. Welcome to the conversation. Welcome back to HAUS Talk Tuesdays. In this episode, we're diving deep into the conversation about building a legacy through home ownership. Our topic today, lease or legacy, choosing the Luxe path to home ownership, better known as buying versus renting. This subject to you guys is brought to you by popular demand. So many ask the question, but oftentimes the answer just isn't clear. But today, I'm going to make this subject as crystal clear as I possibly can. So today we're shifting the mindset, and I want you guys to take notes because the podcast is pretty short, but packed with lots of golden nuggets. You asked for it, and you got it. Now, don't get me wrong. There is absolutely nothing wrong with renting. It's all about preference. But today, we're talking about building a legacy. But for those of you that are looking to build legacy, now is the time to make some money moves. There's no perfect time in real estate. If you have the buying power, then why not take the action? We want to talk about the true cost of renting versus owning. Now, I'm going to break it down to you. I'm going to keep it simple due to the fact that this is a podcast and not a math class. So I'm going to give you a moment to take some notes. Get your pen, get your paper, get your pads, your iPad, whatever it is that you take your notes. Go ahead and get that out for me. And then I'm going to get right down to business. So suppose you're paying $1,500 a month. This is simple math now. We're not talking about luxury math. We're talking about simple math. So suppose you're paying $1,500 a month. Add up. Plus an annual rent increase of $75. Now compare the median home price today, $300,000. The days of the $150,000 for your average home is out the window. Your average home price today is $300,000. The days of the $150,000 for your average home is out the window. Your average home price today is $300,000, at least in Texas. And let's say you're going the FHA route because you are a first-time home buyer. You're really concerned about the cost of the home. You're concerned about your down payment money. So we're going to use FHA. And as a first-time home buyer, FHA requires a down payment of 3.5%. They want you to have a little skin in the game. Because most of the time, guys, if we get something for free, do we really take care of it or manage it like we're supposed to? The annual tax rate, 1.8%. Monthly maintenance costs on the house, roughly $250 to $1,000 monthly, and that's based on the 1% rule. The annual appreciation, 3 to 5%. And your possible HOA dues, I'm going to say about $500 annually. That could be more, that could be less, but it all depends on the association. Your federal tax savings, $1,886. And your estimated closing costs in 5 years, most people will stay in their home 5 to 10 years. But I'm going to give 5 as our magic number today. So we're looking at $27,000 plus $18,000 in agent commission. And this is just an estimation because this could be more or less depending on inflation. Here is the calculated version of renting versus buying. Total monthly payment on rent, $1,500. Buying your home, $4,100. Monthly taxes and maintenance on rent is $20 and $2,300 on buying. Your total payment over the stay for rent is $7,600 and $20,000 for buying. And your total payment less tax savings is $7,600 on rent and a negative $169,000 on buying. The equity built in rent is nothing, and the equity built in the property is $15,000. And then your total net benefit on rent is $2,900, and then your total net benefit in buying is $140,000. Now I rounded those off. Those are not the exact figures, they're rounded. And then your investment, if you were to have an investment, your investment gain from alternative investment for your rent is going to be $10,500, and your gain from your home investment in a buying scenario is a negative $29,459. Now let's take a loan amount into consideration of $289,500. That is a 360-month term with an estimated APR of 6.526% and an estimated interest rate of 6.5%. Now, if you're looking like, woo, I'd rather pay that $1,500 a month over the $4,100 a month, remember, you're talking about investing in your legacy. And if you would like that mortgage payment to go down a little bit, you can always buy your mortgage down with points to get a lower interest rate, or depending on your credit at the time and the ongoing interest rate, that rate could be a whole lot lower. But these are decent interest rates, 6.5% that I have given you. So lease or legacy. So while these costs may sound daunting, remember, this is about investing in your legacy. Sit back, sip some tea, drink your coffee, and enjoy the vibes while I walk you through the 10 steps of the home buying process. So I just gave you an idea of what's the difference between buying and renting. Number 1, get pre-qualified or pre-approved. A pre-qualification is a letter that you're going to give to your realtor, and it's going to be based off the information that you gave your real estate agent. Now, guys, when I say the word realtor, that means that you are part of the National Association of Realtors. You act through a code of ethics and a certain form of professionalism. All real estate licenses are not the same because everyone is not a realtor, but everyone can be a real estate agent. So when you give your real estate agent the pre-qual letter, a pre-qualification letter, that means that you called up your lender, your bank, your credit union, and you gave them the information verbally on the phone, and they based that information off of what you said. Now you have a pre-approval. A pre-approval is a guarantee from a lender. That means that you verbally gave them the information, you provided them with documentation, which is proof, and then they took you through a pre-approval process that gives you a guarantee for about up to 90 days, and it gives you a stronger advantage when you're making offers to your sellers. Number 2, Credit scores and financing options are very important. Scores 700 plus may unlock better rates with credit unions, banks, and conventional mortgages. Scores 600 and below may qualify for FHA loans, depending on debt-to-income ratios, while still acquiring a decent rate. For luxury properties, expect jumbo loans, which require stricter qualifications. Texas FHA loan limits for 2025 for single-family unit homes, you're looking at $524,225. For duplexes, and keep in mind, you're only taking in consideration that you're purchasing one side of the loan. So you're looking at $671,200. Triplexes, $811,275, and a fourplex, $1,800,000. And certain high market counties have a higher limit of $1.2 million, like Bastrop, Caldwell, Hayes, Travis, and Williamson counties. Number 3, you're going to find a trusted real estate agent. And a trusted real estate agent will build rapport and assess your needs. So be upfront about your budget, your preferred locations, desired amenities, important lifestyle factors, schools, commuting back and forth to work, shopping centers, whether you want recreation, clubhouses, those type of items in your neighborhood. Number 4, choosing your dream home. While considering resale value is important, when we buy a home, we want to be like, well, what is it going to sell for in 5-10 years? Your dream home, remember, this is the place that you're going to live in. It should reflect what makes you and your family comfortable and secure. Number 5, negotiating terms. In competitive markets, you may need to act fast. So buyers, please don't straddle the fence. And also, too many demands can weaken your offer. Once your offer is accepted, your contract is binding. So ensure all your terms and negotiations are clear. Number 6, loan processing and underwriting. That means that you've made it through. The bank, the mortgage company, the credit union has your paperwork, and they're going to work for you. So during this period, avoid making large purchases, transactions, or even applying for things that could, like credit applications, during this period, because you want to protect your debt to income ratio and your loan approval. There are often times where individuals will get approved for a loan, go out and buy a car, and the next thing you know, the deal falls through because now their debt to income ratio is out of whack. It is too high for the loan. So if you're going to make any large ticketed purchases, do those things after your loan is approved, after you've moved into the home. Unless your credit and your finances and income are very, very strong. Number 7, prepare for closing. For your protection, get a home inspection. Consult your attorney if needed. Oftentimes in the state of Texas, we don't use attorneys, but if you are in your state and you acquire or require attorneys, make sure you get one and have them to check over your contract and finalize your mortgage. Expect to bring your closing costs in an approved payment form. So money orders, cashier's check, certified funds, but don't bring cash to the closing. Number 8, this is your big closing date. This is the day that the legal transfer of ownership is going to happen. And depending on the agreement, you may gain possession of the property immediately or after a set period. So I know in one of my closings, the seller had informed the buyer that they were going to need an additional 2 weeks to move out of the home. The buyer agreed. But in turn, this home belongs to the buyer. Therefore, the buyer now charges rent for those 2 weeks. So they've made a little money on the side because the sellers are now renters in their home for 2 weeks. So there are often times that you may not gain the keys or access to the property at closing. And also, buyers, you may have a 30-day closing window or a 45-day closing window. But just depend on what's going on through the title company. They may be able to close your loan in less than 30 days, and sometimes it may take longer than 30 days. Be prepared for this. Expect things to happen, and just be patient and be aware. So I just want you to be aware of that, because there are times that you may not close on your closing date. Number 9, move in. It's time to move in. So whether you're moving in a rental truck or riding in a luxury limo for the moment, there are times that buyers, you get that special luxury treatment and you get a ride to your castle. So be prepared. Be prepared. And then number 10, it's time to celebrate. Celebrate good times. Come on. There's a party going on right here. A celebration to last throughout the year. I just had to say that, guys. All right. And congratulations. You stepped into your legacy and future wealth building journey. Stay tuned for more luxurious insight, expert tips, and empowering conversations on HAUS Talk Tuesdays. Let's build legacies together, y'all. So there you have it. And remember, the path to wealth isn't just about dollars and cents. It's about the way you think, the way you serve, and the way you show up in your life and in your business. If you found value in today's episode, do me a favor, like, share, and follow the show on Spotify so you never miss a moment. Help me get up to those future followings that I'm trying to get. And hey, if you're feeling inspired, drop a comment and let me know if owning a home is for you. Until next time, keep building your house on a foundation of luxury, legacy, and lifestyle, because you are made for more and your journey starts now. Thanks. This is Daphne Davis signing off. Until next time, and thanks for joining the conversation.